Welcome to the deep dive. I bet you're here today because you're probably a little a little concerned about what these 2025 tariffs are going to do to the stock market.
Right.
And we have a great article here from the Motley Fool.
Absolutely.
It was published just yesterday, March 23rd, 2025, and it digs into what Wall Street analysts are predicting and kind of how investors are feeling with all this economic uncertainty.
Yeah. I think, at the end of the day, everyone listening is trying to figure out, what does this mean for me? What does this mean for my money? What does this mean for my portfolio? And that's what we want to do today. We're going to break down this Motley Fool piece and try to extract all the key insights. We want to give you a clear understanding of kind of where the experts stand, what they're thinking, and also highlight a really interesting sentiment that we're seeing among individual investors. And we're going to do it all without getting too bogged down in the financial jargon.
Okay. Sounds good. Let's dive right in.
Yeah.
So the article kicks off by pointing out that the S&P 500, one of the broadest measures of the U.S. stock market, has already fallen about 8% from its high back in February. And the article says the main reason for this is the economic uncertainty that's been generated by the tariffs that the Trump administration has imposed.
Yeah, that's right. So, we already have tariffs in place on goods coming from China, Canada, Mexico, even steel and aluminum.
Mm-hmm.
But what's really got everyone's attention is that we're going to see reciprocal tariffs,
Okay.
which are set to take effect on April 2nd. And basically the idea is, if a country charges, let's say, a 10% tax on a car that we're exporting to them,
Mm-hmm.
we can then implement a reciprocal tariff and
Yeah.
charge 10% on, let's say, steel that they're importing into our country.
I see. So it's kind of an attempt to level the playing field, to correct for these trade imbalances.
Exactly.
But as the article points out, there's a lot of concern from economists about potential downsides.
Well, yeah. The real concern is these tariffs could lead to higher inflation. So everyday things just cost more,
Right.
and that it could potentially slow down economic growth.
Right.
And if that happens, that could really hurt the profits of all the companies in the S&P 500. And of course, that would have a negative impact on stock prices.
So we've got these tariffs that are already in place. We've got the reciprocal tariffs coming up. We've got this worry about inflation and slower growth. You would think logically that Wall Street analysts, who make a living, studying these trends, would be bracing for a market downturn.
You would think so, right?
But this is where it gets really, really interesting. The Motley Fool article shows that there's actually a lot of optimism on Wall Street.
Yeah. I mean, it seems kind of counterintuitive, right, given all the uncertainty. But in spite of all these worries about the negative economic effects of these tariffs, the majority of Wall Street analysts are still predicting that the stock market is going to go up in 2025.
Wow. So what is the average target that they're looking at? What are they predicting the S&P will end the year at?
Yeah, so when you average out all the year-end targets from all the different firms, they're looking at the S&P 500 to finish the year at 6,551.
Okay.
And to put that into perspective, the S&P closed at 5,668 on March 21st. So that's a potential gain of about 16%.
Okay. So they're actually predicting some pretty significant gains.
Yeah, I mean, not insignificant gains. And, the article goes into a lot of detail about the specific price targets from different firms. And some of them are quite optimistic, like Oppenheimer, for example. They're predicting it'll hit 7,100. Then you have Wells Fargo at 7,007, Deutsche Bank at 7,000, Evercore at 6,800, BMO Capital and HSBC both at 6,700, Bank of America at 6,666, Barclays and Fundstrat at 6,600. And then you have kind of in the middle, Citigroup, JP Morgan, Morgan Stanley, all around 6,500, a bit lower UBS and Yardeni Research at 6,400. And then on the more cautious side, you have Goldman Sachs and RBC Capital, both at 6,200. And then the most conservative target of all comes from Stifel at 5,500.
Okay. So it sounds like, even though they're all over the map, there's still, most of them are predicting some pretty big gains.
Yeah, exactly. I mean, obviously there's a range of opinions, but it's clear that most of these firms are expecting the market to move higher.
Yeah.
However, there is a really important thing to remember that the article points out, and that is that several of these firms have actually lowered their targets.
Oh, really?
Yeah.
Yeah.
They were more optimistic before, but they've become a little more cautious recently. And they all say the reason is the uncertainty created by these tariffs.
Makes sense.
Yeah. So, for example, Goldman Sachs used to predict the S&P would finish at 6,500, but they've lowered that to 6,200. And they've also lowered their GDP growth forecast. They used to predict 2.4% growth, but they've lowered that to 1.7%.
Wow.
Yeah. And RBC Capital and Yardeni Research, they've also lowered their targets and their forecasts. So it's clear that these tariffs are causing some concern.
So even though they're still predicting gains, they're not as bullish as they were before. But let's move on to the next part of the article, which I thought was super interesting. It talks about the sentiment of individual investors.
Yeah. And this is where we get into something called a contrarian indicator.
Okay. I'm intrigued. Tell me more.
So the article talks about this survey that's run by the American Association of Individual Investors. It's called the AAII for short.
Okay.
And basically, they just ask individual investors how they feel about the stock market. Like, do they think it's going to go up or down in the next 6 months?
I see.
And what's really interesting is that right now the survey is showing a huge amount of pessimism.
Really?
For 4 weeks in a row now, over 50% of investors have said they think the market is going to go down.
Wow. That's a lot of negativity.
It is. In fact, the most recent survey, which was on March 19th, showed that 58.1% of investors are bearish on the market.
Wow. That sounds really high.
It is. I mean, it's near a decade high. The 10-year average is only 33%.
So for those of us who are, not experts on this kind of stuff, why is a high level of bearish sentiment actually seen as potentially a good sign? It seems counterintuitive.
Yeah, it's definitely a little counterintuitive. But that's why it's called the contrarian indicator.
Uh-huh.
Basically, the idea is that when everyone is already pessimistic, when everyone's expecting the market to go down, it means most of the selling has probably already happened.
Oh, I see. So kind of like if everyone who wants to sell is already sold, there's only buyers left.
Exactly. And so any little piece of good news, or even just, an absence of bad news, could cause the market to start going up.
Yeah.
So even though all the headlines are screaming about how bad things are, history shows that these periods of extreme pessimism can actually be great buying opportunities.
Interesting.
Yeah. In fact, the article gives a great example of this. Back on November 2nd, 2023, when bearish sentiment last went above 50%, the S&P 500 went on to deliver a 32% return over the next 12 months.
Wow. That's a big jump.
It is. And it's not just a one-off thing either. The Motley Fool analyzed the last decade of AAII data, and they found that in the 25 instances where bearish sentiment went above 50%, the S&P 500 produced an average return of 22% in the following 12 months.
So it really does seem like this negativity could be a bullish sign.
Yeah, exactly.
So, okay, let's sum up what we've learned.
Okay.
We've got these tariffs, which are creating some economic uncertainty, and that's contributed to this recent dip in the market.
Right.
But despite that, most Wall Street analysts are still predicting that the market's going to go up. And then on top of that, we've got this high level of bearish sentiment among individual investors, which historically has been a really good sign for future returns. So what does all this mean for the average investor? What should they be doing?
Well, I think the main takeaway from this article is that even though there are some legitimate economic concerns out there, the experts on Wall Street are still relatively optimistic. And the fact that individual investors are so pessimistic could actually mean that there's some really good upside potential.
I see. So what specific advice does the article give?
Well, their advice is pretty simple. They say if you're investing for the long term, meaning you don't need the money for at least 3 years, you should just keep adding money to the stock market.
Okay, makes sense.
Because the idea is that over the long term, the market tends to go up. And by investing consistently, you're going to be able to ride out any short-term ups and downs.
So how should investors actually go about putting that money into the market?
They give a couple of different options. The first is to just buy individual stocks. Do your research, find companies that you think have solid fundamentals and good long-term growth potential, and then you can just buy shares of those companies.
Uh-huh.
The other option, which is a bit more passive and a little bit less risky, is to just buy an S&P 500 index fund.
All right.
And basically an index fund just tracks the performance of the index. So in this case, you would be buying a little piece of all 500 companies in the S&P 500.
Okay. And they're saying basically just stay invested through thick and thin.
Yeah. Exactly. Because trying to time the market, trying to guess when to buy and when to sell is really, really hard. And a lot of times people who try to do that, they end up missing out on the big gains.
So it's better to just stay in the market and ride it out.
Right, exactly.
Okay. Well, that's all really interesting stuff. I think the big takeaway here is that even though there's a lot of uncertainty in the market right now, with the tariffs, and even though a lot of people are pessimistic, there are still some pretty compelling reasons to be optimistic about the future of the stock market.
Yeah, I think that's a good way to put it. We've got this combination of, some economic headwinds, but also a lot of potential for growth. And we've got this interesting signal from investor sentiment, which historically has been pretty accurate. So, It'll be interesting to see how this all plays out.
Yeah, absolutely. And as we always say, this is just one perspective. You should always do your own research and make your own decisions. But hopefully this has given you some food for thought as you navigate these uncertain times.
Yeah. I think the key question for all of us is, how do we weigh these different perspectives?
Yeah.
How do we make sense of these seemingly conflicting signals?
Right.
On one hand, we've got these tariffs and the potential for slower growth. But on the other hand, we've got this Wall Street optimism and this historical precedent of the market performing well when investors are pessimistic.
Yeah.
So it's a really interesting time to be an investor. And I think the most important thing is to just stay informed, stay educated, and make sure you're making decisions that are right for you in your individual circumstances.
Couldn't have said it better myself. Thanks for joining us on the Deep Dive.
My pleasure.
And we'll see you next time.